Congress wants your 401k. I'm your host, Steve Van Metre, and thanks for joining me today. And Senate Republicans have their sights set on your 401k. With trillions at risk, including your life savings, well, what are they after? Well, let's head over to Bloomberg, where we picked today's story up with a headline that your 401k is the next midterm battleground for Republicans, as they're using market declines to reinforce their messaging, with issues just beginning to resonate with voters, they say. Dropping balances in 401ks and IRAs have only just begun to surface as a concern among swing voters and focus groups, though usually as one complaint in a litany of grievances over the economy, still mostly driven by frustration over consumer prices, several Republican strategists said. Senate GOP leader Mitch McConnell took to the chamber's floor last week to try to tie Biden to the tumult in markets as Federal Reserve interest rate increases in a crisis in British bond markets roiled investors. But I'll wish him good luck with that, because presidents really don't have any control of the stock market. Now, if you think about it, if they did, well, wouldn't they always want it to go up? Wouldn't they always push it to go up? But what is the factor here that's impacting the market isn't the president, it's the Fed. And here you can see in this chart, we've got the federal funds rate in blue overlaid with the Wilshire 5000 price index, or the total U.S. stock market. And what we can note is that when financial conditions get too tight, when rates get too high, well, the stock market starts to head lower. We can see that here during the dot-com bubble. We see that happen again going into the great financial crisis. We see that heading into the pandemic, where we almost had a recession. Higher rates led to at least a flattening market. And now we have one of the fastest acceleration in federal funds rate in history, driving the markets down, leaving the president almost a bystander to what the Fed's up to. McConnell, who's been working to bolster GOP chances of regaining Senate control in the midterm elections, said recent declines are cutting the value of America's retirement savings just as the cost of living has soared. Well, McConnell, I got some news for you that the stock market, while that is bad news for many Americans' net worth, it's also going to have a big impact on consumer prices. And if you're worried about prices staying high, well, I suggest you check out this chart along with us. And here you can see the consumer price index in blue on a year-over-year rate of change. And I've overlaid the Wilshire 5000 again. Now, I didn't change it to a year-over-year comp. I just left it straight out. And I want you to see that in red, as the stock market heads lower, we can note that consumer prices can stay elevated a bit, but then they follow with a lag. And here again, you see coming into the great financial crisis, the market went down, consumer prices kept going higher, even though the Fed was pivoting at that point, and then they went straight down as a nosedive. Here we can see that happening again going into the pandemic. As the stock market wobbled and started to go sideways, inflation went down, and lo and behold, the market is headed down. And that's telling us that likely next week we could see the beginning of consumer prices come down. Because what McConnell doesn't get, and a lot of politicians don't get, when people have less money, well, they spend less. It's an appeal aimed at older voters who have been the most retirement savings at risk and who reliably turn out for the midterm elections. The contest for control of the Senate in particular will be decided by narrow margins in roughly 5 states, and both parties are focusing on issues: the economy for Republicans, abortion rights for Democrats, and that will motivate their voters, or so they're hoping. The question is, will it weigh on voters' minds? Will it weigh on your mind? When you go to the polls, what will you be thinking? Will you be voting with your heart or your wallet or something else? I'll let you weigh in the comments, and be nice, please do. Let's continue on, because what we can note, it's really all about the Fed here. It has nothing to do with Congress or the president, and it usually never does. Here we can see that the Fed being the big factor, we've got the monetary base and the Wilshire 5000 both on a year-over-year rate of change, and we can note that there's a strong relationship between the Fed's balance sheet and the direction of the stock market. We see that the Fed is accelerating to the downside its balance sheet as it unwinds with quantitative tightening, and that's putting downward pressure on the stock market. So while we're seeing the Senate Republicans are using the decline in 401ks to hopefully bolster votes, what they don't realize is that it's the Fed. And what's happening here is you have to understand how the global monetary system works. Somebody has to buy our debt. What they don't get is the Fed's not buying our debt. Commercial banks are selling off too, looking to bolster their loan book, and foreign central banks are net sellers because of the dollar shortage. And that means that U.S. citizens, Americans, investors have to buy our debt. If they don't, the market will keep going down until they do. You don't believe it? Well, look, every market bottom involves U.S. investors buying treasuries. The White House Press Secretary Karine Jean-Pierre said last week in response to a question about market turmoil that Biden has presided over one of the strongest job markets on record and that the U.S. economy is making a transition to a more steady and stable growth. Well, we're going to poke holes in that here in a moment too, being bipartisan on poking holes in both sides of this picture. Let's continue on, because while retirement savers often include bond investments to cushion the blow in a stock market downturn, this time bond market losses have also been severe, adding to the damage of 401k portfolios. And this is largely now because of the Fed. When we look, and we've seen on this show, we've looked at the data, we know that right now, normally and throughout history, the Fed is at least paused, if not cutting. And of course, when we look at the job market here, the non-farm payrolls report, we're going to see that we're already in a bad trend leading the economy down. So we're going to challenge this whole view that President Biden's presiding over one of the strongest labor markets, because in the second half of his term, that might change in a big way. How potent the GOP highlighting the market slide will be remains to be seen. Anxiety over retirement savings is ticking up as the market heads lower, and Americans are growing more confident about the economy overall following a drop in gasoline prices and easing of overall inflation, although I doubt a small drop in gasoline prices is going to change the sentiment of Americans who are watching their investments go down. But there's one thing you shouldn't have anxiety over, and that's your portfolio crashing along with the market. I'll put a link up here to Portfolio Shield and in the description below, because let's talk about the jobs market now, and this is going to be a big factor as we head into the midterms later this year and early next year. Are people likely to keep their jobs? Well, probably not. U.S. jobs on the rise while unemployment drops, keeping pressure on the Fed as payrolls climbed 263,000 last month and jobless rate fell to 3.5%, reaffirming traders' bets on another big Fed rate hike coming potentially in early November. The labor force participation rate, the share of population is working or looking for work, eased to 62.3%. Now, I will note, we've talked about in the past that what happens here as the stock market goes down, people return to the labor market. So what we should see is that number head higher. Oddly, we're not seeing it lower yet. Perhaps maybe the market needs to fall even further. The jobs report showed average hourly earnings were up 0.3% in August and up 5% from a year earlier, a slight deceleration from the prior month, but still historically elevated. The solid increase suggests the Fed will have to continue to raise interest rates as it aims to rein in rapid wage growth that has bolstered household spending. And here we can see when we talk about the non-farm payroll report, one thing that's important to understand is it is a smoothed report. So it was by design meant to fluctuate out any outlying large moves higher or large moves lower. And so when you look at it, the number is not as important as the trend. And what I want you to see is the trend in payrolls has been declining for months. And we can go back here to, of course, April. We see it was at 428 and then it dropped to 390, then 372. Here you have that outlier at 528 that the market got excited about, and look, it smoothed it right back out, 315, 263. And what this is telling us is a strong labor market that, of course, again, the Democrats are saying is great. That tide is turning. Over the next couple of months, we should see the payroll report continue to head lower, and possibly by December, which would be terrible, we could see it even contract, but most likely we'll see that contraction early next year. And this will give you an idea. Now, I've had to take off the most recent data and show you that the federal funds rate here is a factor. The Fed tightening does have an impact. And while the Fed doesn't directly create or destroy jobs, it does tighten financial conditions. We can look at the real estate market and see just how much higher rates are going to lead to job losses. And we note here the federal funds rate in blue, and we have all employees total non-farm and change of thousands in persons. And you can see the deceleration going into the recession here in the early 90s. You can see the deceleration going into the dot-com bubble. You can see the deceleration going into the great financial crisis. And that's the same deceleration we're seeing now with the Fed aggressively tightening, telling us that the path of job creation is lower and soon to be negative. Central bank officials have been clear recently about their commitment to taming inflation, even if that leads to higher unemployment and a recession, because they say failing to do so would be worse for Americans. Now, I want you to understand what the Fed is saying here. It would be worse if inflation stayed high than if you lost your job. I don't know what you think about that, but I'm not sure I agree with that at all. Fed Chair Jerome Powell said last month that slower growth and a softer labor market are painful to the public, but there isn't a painless way to get inflation down. He's absolutely right. The actual way to get inflation down is to cause a recession, put people on the unemployment line, have their incomes slashed, and they will cut spending. And that indeed is how we usually see inflation come way down. Fed officials keep hammering hawkish message on rates heading up. As Waller says, financial stability worry, no reason to slow hikes, even though they likely will. The focus of monetary policy needs to be fighting inflation. We have the tools in place to address any financial stability concerns. I'll take that bet, and should not be looking to monetary policy for this purpose. But what we can see, of course, in the next two charts is the direction for rates is lower. The bond market's telling us this. It's been telling us. The Fed's ignoring it. As you'll see, check this out. Here we have the federal funds rate in blue overlaid against the yield curve in red, and I've drawn a baseline here in yellow for the yield curve. And what we note is when the curve, its red line, is below the yellow line, it means it's inverted. The steeper in the inversion, further below the yellow line, the worse it is, the more the bond market's telling the Fed, you are making a mistake and going to drive us into a massive recession. When the Fed ignores it, which they typically do, you'll note that they end up slashing rates down, and we see that the red line rises, which is called a steepener, meaning that rates are falling, and you can see that happens every time. The bond market's saying, look, the path for rates is likely lower, not higher. And what does it mean for inflation? Well, it says the same thing. Here we have the same yield curve chart now overlaid with the consumer price index in blue on a year-over-year rate of change. And notice when we have a inversion of the red line and then it steepens, inflation comes down. You see the blue line falls. We see an inversion, a steepener, and then eventually consumer prices down. We have an inversion, steepener, inflation down, rinse, repeat, telling us that when this curve inverts, when we see the yield curve finally invert and that red line ahead higher, inflation's going away. So what do Republicans want? Well, they don't want to take your 401k. They just want to see it go up. They're using that as a political tool. But the reality is for them, even if they do win, and we'll see what happens, well, the odds are 401ks are likely to head lower no matter who's in power. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.